This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 6, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is sitting on a dime at $744, but look closer. The Nasdaq 100 has sliced through the air, dropping nearly 2% while the Dow holds firm. We are watching a market fracture in real time. Before we dissect the break in the tape, let's look at the horizon. Over the next 48 hours, the earnings calendar offers a clear stress test for our defensive thesis. On July 8th, we see estimates for AZZ, BSET, and HEAL. But the heavyweight battle arrives on July 9th, with PepsiCo reporting estimated earnings of $2.19 per share. As CIPHER noted earlier, PEP acts as the critical defensive anchor for consumer staples. Any deviation from that estimate will validate or invalidate the flight to safety narrative we're tracking today. Additionally, Delta Air Lines reports on the same date, offering a look at travel demand, though the broader market focus remains squarely on whether defensive yields can withstand the scrutiny of quarterly results.
And for the strategist, the takeaway is simple. Don't bet against the tape, but watch PEP closely. If Pepsi warbles the entire defensive basket, the healthcare sector, the utilities sector, consumer staples, faces an immediate liquidity check.
Here is the snapshot as of 9:19 Eastern Time. The S&P 500 ETF, SPY, is essentially flat at 74.78, down just 13 basis points. But beneath that headline number, the architecture is cracking. The Nasdaq 100, QQQ, is down 1.73% at 712.60, creating a 1.6% relative performance gap against the S&P. Meanwhile, the Dow Jones Diamonds is up 1.05% at 527.88. The rotation is explicit. Capital is fleeing the heavy growth bellwethers and pooling into industrial and value exposure. Today, we analyze the mechanics of this split. Three headlines are driving this pre-market volatility. First, semiconductor equipment leader KLAK is surging 5.8% on a specific investor narrative involving Jeff Bezos pouring money into a new venture. Second, AMAT is also gaining 5.3%, though our internal models flag a severe valuation disconnect here. Third, and perhaps most alarming for risk appetite, cybersecurity giant CRWD has collapsed 74.9% on 10,400,000 shares in volume. Let's get the read on what this means for the sector. The CRWD move is the emotional center of this morning. 74% gone overnight. That is not a correction. That is a panic. It overrides the modestly positive news flow around Amazon and Google. Retail and algos are seeing red ink and pulling leverage, regardless of what the headlines say about megacap tech.
Agreed, Pulse. And it's not just sentiment, it's a structural crack. A 74% wipeout in a major tech constituent is a credit stress signal masquerading as an equity move. It tells me that the flight to safety trade into the healthcare sector and the financial sector is being forced by a lack of buyers elsewhere, not because investors believe in healthcare fundamentals right now.
Let's start with the core tension. SPY is holding at 744.78, but QQQ has broken down to 712.60. Grid, map the structure here. Are we looking at a support bounce or a breakdown?
We are looking at a breakdown that hasn't quite hit the wall yet. QQQ is sitting at 712.60. That is 98 points above the hard support floor of 702.81, established on June 26. It feels safe now, but technically it is in the danger zone. Meanwhile, SPY is trading in the upper quartile of its 10-day range, approaching the ceiling of 751.31. The problem is that SPY's stability is synthetic. It's being propped up by diamonds and IWM stability, while QQQ is acting like a falling knife. If QQQ touches 702.81, we trigger algorithmic liquidation protocols designed for that exact level.
And that algorithmic reaction explains the flow disconnect. Look at the sector level. The technology sector is down 2.71%, but inside that sector, you have this bizarre bifurcation. You've got CLAC and LRCX gapping up 5% on the Bezos narrative, while the rest of the semiconductor index bleeds. This isn't a sector rotation, it's liquidity trapping. Institutions are using the CLAC/AMAT pops to offload the broader tech exposure without spiking the VIX immediately.
Exactly, and the VIX doesn't care. It's sitting at 15.81. That is the bottom of its 5-day range. The options market is screaming complacency, while the spot market is selling off. That divergence between the VIX at 15.81 and the QQQ dropping 1.73% is the definition of a sell-the-news trap. The headlines around NVDA and Amazon are carrying bullish sentiment scores of plus 0.51 and plus 0.7 respectively, but the price action rejects them hard. The crowd believes the story, the tape disagrees.
Which brings us to the risk of that complacency. You have the VIX pinned at 15.81, suppressing the fear gauge, while CRWD is vaporizing. That is a lethal mismatch. When the VIX finally breaks out of that 15.75 to 19.45 range, it won't be a gentle drift. It'll be a repricing of all that unpriced risk in the tech sector simultaneously.
So, Grid sees the technical floor at 702.81 for QQQ, CIPHER identifies the liquidity trap in the semis, and Pulse flags the VIX complacency. What does this mean for the broader S&P 500 defense?
Mean SPY at 744.78 is a mirage. The relative performance gap between SPY and QQQ is widening to 1.6%. In a healthy correction, you expect some leadership change, not a total abandonment of the growth engine. SPY is failing to make new highs against its own local resistance of 751.31, while QQQ is testing lows. The structure is deteriorating, not stabilizing.
While tech fractures, capital is flooding into defensive sectors. The healthcare sector is up 2.63%, and the financial sector is up 1.53%. CIPHER, walk us through the fundamental drivers here. Is this a legitimate value play or a panic move?
It's a panic move disguised as value. Look at the valuation metrics. AMAT is trading at $635, yet our DCF model assigns a fair value of $309. That is a 105% premium. When you have a stock trading double its intrinsic value in an environment with a 4.17% CPI print and a Fed funds rate of 3.63%, you are not buying value, you are catching a falling knife. The rotation into the healthcare sector is not because healthcare is cheap. It's because the technology sector is mathematically unsustainable at current yields.
That connects directly to what Grid flagged on the QQQ floor. If the technology sector continues to bleed at 2.71%, the flight to safety becomes a fire sale. The question is whether the healthcare sector can absorb that fire sales volume. Historically, when the yield curve flattens, currently at plus 0.35 parts per hundred, the financial sector usually gets crushed. Yet the financial sector is up 1.53%. That defies the macro logic.
Because it's a short squeeze apex. Look at the 10-year, 2-year spread at plus 0.35. That is flat. Financials should hate that. They are rallying only because everyone else is selling. Once the short covering runs dry, the financial sector will revert to the mean of the yield curve. You cannot buy the financial sector on yield curve flattening and expect it to hold. It's a trap.
And the sentiment scores confirm it. There is no organic bullish momentum in the healthcare sector. It's purely reactive. The fear of missing out on safety is driving bids, but once the CRTD crash stops dominating the feed, that bid vanishes. We are seeing a correlation break where defensive assets move inversely to tech not because of fundamentals, but because of forced deleveraging. So, the consensus is that the healthcare sector and XFU strength is fragile. What about the outliers? CLAC and LRCX are up over 5%. Is there any merit to chasing these names?
No, CLAC and LRCX are moving on a singular Bezos-linked narrative. It is idiosyncratic noise. In a sector down 2.71%, a 5% gap up on news is a liquidity event for sellers, not buyers. The volume profile on CLAC shows heavy distribution at the open. If you chase this, You are providing exit liquidity for the institutions, unwinding the broader the technology sector exposure. Stick to the macro, ignore the micro headlines.
Technically, the CLK chart is irrelevant to the sector trend. It is trading far above its moving averages detached from the technology sector beta. It's a bubble within a bubble. When the broader the technology sector reclaims its downward slope, CLK will gap down to fill that void. Do not mistake idiosyncratic alpha for sector beta.
Finally, let's look at the breadth. The Russell 2000, IWM, is down 0.58% at 297.58. Small caps are lagging large caps. SPECTER, audit this risk. Is the small cap underperformance a sign of broader systemic trouble?
It is the canary in the coal mine. IWM is trading at 297.58, hovering near the lower end of its 10-day range. Small caps are highly sensitive to the cost of capital. With CPI stuck at 4.17% and non-farm payrolls showing only 57,000 jobs added, the labor market is cooling. Small caps cannot survive a higher for longer rate environment. The fact that IWM is underperforming SPY by 0.5%, while the technology sector is crashing, suggests that speculators are exiting speculative risk entirely. This isn't just a tech correction, it's a risk-off regime shift.
And that regime shift is why the SPY/DIA divergence is so telling. Diamonds is up 1.05% at 527.88. Industrials are holding because they have tangible assets and dividends, unlike the speculative small caps and duration-sensitive tech giants. The market is voting with its wallet. We want cash flow today, not promises for tomorrow.
So, to summarize the risk landscape, growth is fracturing, defenses are overextended, and small caps are shedding risk. What is the actionable framework for today?
The framework is preservation. We are not calling TARPs, but we are observing confirmed structural weakness. Grid identified the critical QQQ floor at 702.81. Until that holds, the path of least resistance is lower. CIPHER highlighted the valuation absurdity in names like AMAT. Pulse warned of VIX complacency at 15.81. My directive is clear: reduce duration. Exit the high multiple tech exposure that lacks earnings validation. Rotate into the defensive yields only if you are hedging, not hunting. And absolutely do not chase the Bezos-fueled gaps in CLK or LRCX. They are traps.
That concludes our pre-market analysis for Monday, July 6th. Key takeaways. The S&P 500's flatline at 744.78 masks severe Nasdaq weakness, with QQQ testing critical support at 702.81. The rotation into the healthcare sector and the financial sector appears reactive to tech sell-offs rather than fundamental strength, compounded by extreme VIX complacency at 15.81. Keep a close eye on the QQQ breakdown and the earnings report from PepsiCo on July 9th. This has been the ShadowQuant Equities Edition. Stay disciplined. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.